Market strength continued into August, despite concerns surrounding an economic slowdown and inflation's recent return. One of the drivers pushing stocks higher was, ironically, disappointing U.S. employment data that came out in July. The report wasn't promising, as it included downward revisions to prior month data that set the bar even lower. With investments, sometimes bad news is treated like good news. In this case, a softer labor market tipped the scale in favor of the U.S. Federal Reserve cutting interest rates at their upcoming September meeting. The same can be said for Canada, admittedly. With exports plunging throughout the second quarter as tariffs began to take their toll, our economy seems to be in even greater need of central bank support. While short-term yields have fallen in anticipation of more forgiving monetary policy, longer-term rates have not experienced the same relief. In fact, in recent days, the yield on 30-year U.S. Treasuries has risen to the highest level since 2008. On the surface, this would appear to be unusual, but bond yields are complex. Shorter-term maturities are typically steered by the expected path of monetary policy. Longer-term yields are impacted more by inflation expectations and creditworthiness. Both factors have had to come to terms with policies coming out of the White House. Tariffs have sparked higher inflation by passing along this hidden tax to consumers through price increases. The hope is that these higher costs will turn out to be transitory and revert back down later in 2026. But global trade policy is highly uncertain right now. We prefer to prepare for different scenarios rather than anticipate a specific one. Bond investors are also concerned about President Trump's ongoing pressure to influence interest rate decisions. First, with periodic threats to replace the Fed chairman, and more recently with the firing of another Fed governor, which is now being challenged in court. Central bank independence is a crucial stabilizing force in the market and in managing inflation expectations. If political pressure undermines it, confidence is likely to fall as well. Investors are also keeping an eye on the United Kingdom and France, where long-term bond yields have soared in response to potential fiscal crises. It is a clear reminder that investors do care about government budget deficits and rising debt levels. American debt levels have been deteriorating for years. Addressing it would be unpopular, so Washington continues to sidestep the issue. Investors appear to have taken the weakening fiscal balance sheet in stride, but that may not last forever. At Bellwether, we pride ourselves on the institutional quality portfolios that we construct for our clients. One of the core tenets has been, and will continue to be, diversification. As such, our strategies typically include a mix of fixed income and equity investments across both public and private markets. Typically, the value of each tends to react in different ways to changing circumstances. This is known as low correlation, and despite the technical term, the positive is that it provides a smoother ride over time for our clients. This can also be seen at the next level of diversification, where we have invested in various industry sectors. As you are likely aware, technology, and specifically AI-related stocks, has been a key driver of American exceptionalism for the past couple of years. However, in Canada's home market, gold stocks have become a major driver of performance after years of underwhelming returns. Price movements in this commodity have never been easy to predict, since they tend to be driven by investor sentiment rather than the traditional relationship between physical supply and demand. We tend to view gold mining stocks as somewhat of a portfolio hedge against a variety of risks, including inflation, a weaker US dollar, and global conflict. The price of gold has soared over the past year as the world is dealing with all of these factors right now. The lesson here is that no one, including professionals, has a crystal ball in predicting which types of investments will perform the best or worst in a specific time period. Sometimes public market stocks in the US will lead, at other times private infrastructure investments in Europe may be at the top of the pack. We sense that we are in the midst of a change in market leadership, and as per usual, proper positioning will be vital to make the most of what comes next.